If you don't protect yourself, what we're looking at is the complete collapse, potentially the complete collapse of the fiat currency system and everything that depends on it.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And yes, you guessed it, I'm no longer in Costa Rica. I spent the whole month of January out of the vault into Costa Rica, but now I am in Dhaka, Bangladesh. As you can see, you might hear some noise in the background, but that's just the beautiful music and orchestra of Bangladesh in the background. But with that, I just want to mention here, from the entire Live from the Vault team worldwide, we really want to thank you for your continued support. And as you can imagine, this community just keeps on growing and growing and growing thanks to you, the Live from the Vault community, and the communities all over the world now. It's just incredible. And there's a lot to talk about during these historic times. And fear not, because we have the one and only Andrew Maguire, and he's in the house and he'll be talking gold. You're not going to want to miss this. Why is that? Because it's going to be an amazing episode. I want you to fasten your seatbelt. Live from the Vault gives you access to information and updates that you just can't get anywhere else. And this episode will be no exception. With that, let's head over to the UK and talking gold with the one and only Andrew Maguire. Now, Andrew, let's start off by connecting all the dots here between what you reported in our last two episodes, our 2 weeks ago, our last episode just 2 weeks ago, and the extreme volatility that we're evidencing right now.
Yeah, Shane, that's great. Let's get that done. Just to say, I'm going to be bringing our very good friend, Alasdair Macleod, on a bit later on in the show here. But because we always have so much requests for a market update, let's get the market update done, and then we'll bring our good friend Alasdair in. So, Shane, to answer your question, let's look at this recent extremely volatile action. I mean, what caused it and how it's going to get resolved. That's the issue we're going to kind of look at here. And we'll begin by looking at the elephant in the room. These are the big footprints, the cartel-driven, counterintuitive, paper-centric action that's really evidenced a rinse of the paper element. This is important. The paper element of the recent gold price rally that drove gold to a 10-month highs. Now, but please be aware, we're focusing on the paper element here. And par for the course, look, we always expect obligatory algo-driven paper market volatility into major news events, which we've had, which were like Fed events, non-farm payrolls last Friday. Look, it's really easy to take advantage of COMEX-centric commodity trading advisors. That's the CTAs, or to put another way, the speculators. It's easy to take advantage of these non-delivery guys into these algo-driven events, which is really what we're focusing on here. Now, as it happened, FOMC exposed a boxed-in, very much more dovish Powell than was expected, triggering a really strong gold rally, and that drove gold into those 10-month highs very next morning into very strong Asian physical buying. Now, as a reminder, these CTAs are essentially the speculators managing money for clients and themselves, and are completely blinkered to real supply-demand fundamentals. They exist in this silo of the COMEX, the casino. However, post-FOMC, this race into safe haven paper and physical gold broke out some really important resistance levels, which began triggering there was previously some very bearish bets, tricked-in bets by these CTAs, who'd put short stops above the market to protect themselves in case the price rose. And as is always the case, when this herd is being run from pillar to post by the house, this short covering to buy back these bearish bets reversed into very large leveraged CTA paper-centric buying. Now, it's this paper element of the buying that set everything up for a rinse. And as we have time and time again pointed out, if it was not for this heavily margined group of COMEX-centric paper traders who have no mandate to ever take delivery, the cartel would have no fuel to game these ranges. And that's what part of the education process here that we're trying to bring to people. Don't play this game unless you are a professional. It's always the case. It was the sudden influx of naked short CTAs that provided the sell ignition fuel for the cartel. Now, the scope of which, this is important, is limited to what volume of naked longs, or shorts for that matter, can be sucked into the COMEX pit managers' tables for the house to bet against, with the objective of the house rigging prices back into line with these deeply underwater house bets against gold and silver breaking out to the upside. They were caught out. It was breaking out. Now, paper gold is the only tool left in the cartel's toolbox, and with the physical markets increasingly migrating outside of the LBMA house ring fence, they are scrambling to exit underwater derivative bets placed under gold. They're going to have to do this in 2023. The house had not factored the central bank race into unleveraged physical gold, which had wrong-footed their bearish paper gold bets at the commencement of 2023. Now, we've been witnessing a defensive action just now, since this is what this volatility is about, which has largely cleaned out and backfilled the froth element of a strong move into physical gold and silver. Now, these are rigged markets, and officials and their agent market-making insiders are always in the loop of the bulk of the upcoming non-farm payrolls data. Powell denies that we get the data beforehand or much beforehand. They do get the bulk of enough to sufficiently enable them to set up the insiders, who are agent banks for the officials. There's enough information for them to set up the sell ignition point, knowing that this was going to be a beat in this case, and they know the exact margin pain points. I mean, the CTAs are the people that borrow this from them. Their financing is done by the market makers. And they borrow it, so they know exactly where their pain points are, where they will put their stops. And so really what happened was as soon as we saw this enough froth to be rinsed, they literally pulled the bids with their market makers, pulled the bids, then shorted gold and silver futures in sufficient size to trigger a sell ignition. We've seen it time and time again. Now, while we anticipated this obligatory algo gaming into non-farm payrolls, the full gap closes really exceeded initial expectations in the process, actually driving April gold into deep, actionable backwardation to spot, meaning that that you could clearly see that the selling pressure was 100% COMEX centric, because this is an actionable trade, especially with Basel III conditions being valid, in place. And as far as the massive headline non-farm payroll beat was concerned, it was undoubtedly politically motivated because Biden and Harris, they were already in the know of the upcoming known beat. They were already scheduled to speak after the release. They only do that when there's something to crow about. Something they wouldn't have done if it had been a bad headline number. And then Bloomberg, they came out, and literally they said, basically, this number seems too good to be true. That's because it's too good to be true. This is their interpretation of it, talking about seasonal factors, past, and revisions to data, and that, yes, the labour market is tight, but they were just also assessing that the Fed wouldn't place too much weight on the headline jobs numbers. Of course, the algos did. They game it. However, pre-programmed insider-run high-frequency trading bots managed to rinse out every single fresh non-delivery CTA long in the April gold futures contract all the way back to the 11th of January levels. Now, while in the extremely rigged leveraged silver market, we saw a far, far bigger rinse. If you think about it, just on non-farm payrolls day alone, last Friday, a ludicrous and totally implausible 26,500 tons of paper supply, close to 85% of all 2022 global silver supply had changed hands just after non-farm payrolls into the close. Now, GC, Gold Futures, fared a lot better. They managed to successfully rinse out the CTA longs added from the 11th of January. And while the naked short momentums, then the momentum traders come in and these are naked short. They just are chasing the momentum down. They have the bit between their teeth and have clearly been attempting to troll round numbers. They did 1900. Now they're targeting 1850. That's what they're doing. But insiders exposed to the deliverability of net stable funding compliant spot gold are reported obviously to be 1-to-1 long against these blinkered sellers. Really, it's restricted to how much they can suck in.
All right, Andrew, thanks for that update about gold. And here I am in Bangladesh, and, gold is everywhere. Women wear it all over the place. I just went to a pre-wedding and there's gold everywhere. And apparently men have it hidden in all places. But let's talk about my beloved silver. It's been hit hard now. And what are you seeing from a wholesale market perspective with silver?
Yeah, great question, Shane. And that's what really we need to answer. I'm really glad you brought it up. Look, silver is not NSFR compliant, unlike gold. So in order to track the insiders' footprints pitched against the speculators, to best assess what to expect, we need to look at the casino's option structures, which really gives us a good view into the insiders' footprints. Now, these sweet spots are usually quite accurate. So we've got March futures contract, which is the current contract, going into options expiry and rollover in delivery in 2 weeks on the 23rd of February. And this is the first delivery contract of 2023. Now, this is going to be a large delivery, hence the outrageous capping directly related to insider bets against silver closing above $24. Now, the paper bets are all interconnected with a very large visible OCC bets, which is the bets reported on the Office of the Comptroller report, which is published quarterly, which directly relate to the large wrong-footed SLV. Yes, this is the illusionary world of the ETFs we highlighted in our video last week. So yes, these are all interconnected. So it's much larger than people realize. Now, silver futures has suffered a much more aggressive chart painting attack, which is what it is, which has left wholesalers largely actually sitting on the sidelines, waiting for options expiry gaming to offer better prices. So really that's a bit confusing because we're seeing the likes of, say, Standard Chartered not taking wholesale supply, not taking the refiner supply. They're waiting and deliberately waiting in the hope that the pricing will get better. However, liquidity providers on the other side of the coin are accessing this action should begin to fade into very strong returning Indian spot silver demand. So these are spot, because it's not NSFR compliant, when you buy the spot price at the fix, then you lock that price in, then you can then demand physical delivery at a later stage. So you're not driving up the price, but you're locking in the price. And then and this is going to, because they need to accommodate extremely strong physical and retail demand. It's continuing. And for the record, just to illustrate, India consumed almost all global demand of silver demand in 2022. And in 2023, it's estimated to be sufficient to create a supply deficit. Ultimately, this is going to really reignite global wholesale physical demand. So, they consumed pretty much 85% of everything that was produced last year alone. Now, it's clear the short sellers are using any thin conditions, liquidity conditions, to take out each day's prior low by a couple of ticks. You've noticed that each time you look, it's just a couple of ticks lower. However, Importantly, this is not generating any further large sell ignition, which actually indicates there are zero specs left to be rinsed and that all the selling is momentum-based, naked short with insiders long against them. So yes, we may see more attacks, but this is building up a huge long position for the insiders in the house. Now, the LBMA CME cartel are wrong-footed in the bigger picture, and given physical settlements are increasingly being squared outside of the LBMA CME siloed spot ring fence, and obviously they're using the diluted spot fix to benchmark, and then we've talked about exchange for physicals and how that flows into the over-the-counter markets, and they're also we're actually seeing some forced deliveries at the back doors of the COMEX. Now, this has actually slowed down a bit because everyone's waiting for a better price. Now, the cartel is a kind of a gaslighting kind of situation. Now, the cartel is now desperate to short cover naked short silver bets, but are limited to how much CTA and momentum short sellers wrong footing they can generate. Now, the option structure just indicates insiders have been short covering. However, the bets against 24 are still embedded, so be aware of that. Now, we're tracking the changing option structure, which still indicates a sweet spot of $23.80 at this time. So really, silver is coiling for a large move higher, is what we're saying.
Hey, Andrew, thanks a lot for that short-term update. Can you also do the same, maybe give us a short-term estimate for what's happening in the gold market here?
Yeah, the selling is gold futures generated. Obviously, we've just indicated how we can discern that. And it's been undoubtedly been a coordinated US-centric official attempt, PSYOPs operation, trying to really gloss over the fact that the physical gold market is exiting the LBMA CME ring fence into competing unfriendly as well as increasingly incentivized Western central bank and sovereign buying. The CTAs don't get this. The immediate option sweet spot is evidencing a scramble to exit the previously strong resistance bets against 1900, which we moved into the beginning of the year with. That's now folded, with the current sweet spot migrating higher to something like 1915, which is an extremely compressed price considering it's paper generated. However, there's increasing support growing into the 1940s, and the 1950 resistance is starting to look a little magnetic. Now, very short term, this option structure provides an insight into the paper market footprints, where we're evidencing the rinsing of highly leveraged non-delivery futures contracts into a very strong unleveraged central bank demand physical market. And to better assess gold's 2023 prospects, we really have to look at the bigger picture, don't we, Shane?
Yes, Andrew, thanks for that update. And can you also give us an update on the progress of what you call the gold commoditization process right now?
Yeah, Shane, and let's look at that. That really takes us on to the larger picture, namely the utilization of physical gold as a de-dollarizing currency war missile. Now, we see the current US-centric PSYOPs operation as really a feeble attempt to counter this de-dollarizing mandate instigated by Russia at the commencement of 2023 trading. We did a lot of research on that, and nothing's changed on that. But the Fed is on its own here, and that's apparent as every other central bank, including the Bank of International Settlements, is long gold. Now, fighting global central bank and institutional safe haven physical demand with paper gold is as ill thought through as the now very evident backfiring of Western sanctioned packages, of which it is one clearly. And there's little doubt that following Russia throwing its glove in the ring, weaponizing physical gold against the dollar at the open of New Year trading, catching all of these guys out, officials were caught flat-footed, but will be now a little bit reluctant to dig a deeper hole. Now, with the US-centric officials, they've had some limited success. They had some limited success in psyopsing the market down. That was in August 2020, again in March 2021, when we were in the 2000s. And that was after Russia employed the physical gold trade to bolster its currency. And it was just a fight back of paper gold. By the time the sanction-linked PSYOPs operation concluded in November 2022, and we talked about it at the time, global central banks had bought the most gold since Nixon closed the gold window 50 years ago. I mean, who the hell wants to be short here? This is exactly what we predicted would happen. When fighting global physical demand with paper gold, the lesson does not go unnoticed, and the current feeble US-centric attempt to counter a physically driven central bank race into physical gold, to counter that with paper gold, medium term, this is going to backfire dramatically. And this fresh mandate by Russia to create a gold-backed currency to price all commodities will run over paper gold sell attempts. And obviously, the momentums it'll continue until the momentums don't have enough supply to offset physical exposure for the house. Now, bear in mind, unlike the US, every other central bank facing the physical markets, including the BIS, is now long gold. Now, my friend Alasdair Macleod is going to join us in a little while, and and I want him on because he's also drawing unwanted attention to this currency war with Russia, which single-handedly is capable of destroying the dollar at a far faster pace than anyone has factored in. Alasdair, as I say, will join us shortly, but reference is being drawn to Sergei Glaznev's recent article in a Russian newspaper. And he talks about this too, telegraphing the settlement of trade balances between a wide range of members of the Shanghai Cooperation Organization, the SCO basically. And it will increasingly incorporate physical gold. And considering the SCO family encompasses something like 3.8 billion members, the scale of the upcoming de-dollarizing velocity is as yet not priced into the dollar. August looks like the formalized date for this attack launch, but we've already seen evidence of the gold for oil and some commodities as already underway, and we talked about that last time. Given that the physical gold grams are now formalized as the benchmark currency to price a wide range of commodities in the future, including silver. And Shane, that is for you, including silver, from a real supply-demand perspective. Paper diluted gold in the hands of Fed agent banks is grossly undervalued. Almost every single trading bank is now positioned for a Fed-triggered commodity supercycle, with expectations of record commodity prices in 2023. There is a consensus. It has to be. It's Fed triggered. Into this supercycle, gold and silver are grossly undervalued. And as far as commodities are concerned, silver will outperform, with expectations also of record 2023 prices. So really, to sum it up, while the paper market CTAs myopically focus on a chart painted, here, these charts here are just, they're just constructed to lead them by the nose. And they focus on this drip-fed, house-diluted supply, demand, price data is nothing to do with reality. They completely miss that the official reported 1,136 tons of physical central bank gold demand into 2022 Basel III NSFR compliant conditions, that recorded the highest central bank demand since Nixon closed the gold window 50 years ago. Now we know that is what was and continues to that what is reported and continues to be reported is just a fraction of real central bank sovereign demand. Much of it is, of course, transacted by third parties, and there's no requirement for them to disclose it. Essentially, the gold-dollar conversion window has been reopened, and this increasing physical market liquidity will embolden the ability to exchange fast appreciating dollars for underpriced bullion. Again, we talked about the potential for this liquidity in our last episode. And while Fed agent trading banks are short gold for the Fed, it's not the case for these same insiders' house accounts. They're not stupid. Liquidity providers and our well-placed contacts continue to report every single first-tier bank, along with the BIS, are long physical gold for their own accounts.
All right. Now, Andrew, that's exciting. What's happening here, gold and silver, is exciting. And I know everyone's also excited about hearing from Alasdair Macleod by popular demand. But listen, we've done over 100 live from the vault shows, and way back. Let's talk about the BIS, because you've been talking about the BIS. You've uncovered this BIS story back in 2017, and long before everyone else. And I understand that you have a very important bullish update regarding the BIS. Can you share it with our viewers now?
Yeah, and in fact, it's funny enough, I was just, somebody sent me a copy of the Russian television interview I did with Bart Chilton in 2017, where he was asking me about gold, and I said, watch out, Basel III is going to change this game. So onto the subject of the BIS. Just as predicted, when we commenced 2022 trading, we assessed that it would take a full year for Basel III NSFRs to be completely implemented, and that the BIS was going to also square all of their gold liabilities. And right on cue, swaps was squared to zero by the last trading day of 2022. And really, GATA's Robert Lambourne produced a really good analysis of this, and it can be accessed on of this 12-month unwind of over $500 to zero, and it can be accessed on the GATA website. So GATA is a really powerhouse of information, and you're going to find a lot of resources there. So really encourage everyone to go there. Now, we, along with our first-tier liquidity providers and the bullion bank contacts, was certain that this elephant in the room that was being completely hidden out of the casino was going to ultimately force the BIS to square up all of these over 500 tons of leases and swaps by the end of the year of 2022. Now, once we once again picked up on this thread directly after, if you remember, the March 2020 EFP implosion, where we saw $100 spread per ounce spreads between the spot market and the futures. It blew up. This is what caused the BIS to implement NSFR compliance, because we have a $70 trillion gold derivative market, and if it had collapsed, it would have taken down all the banks. And so really what we're seeing here is these physical backing measures were fast-tracked from 2020 to commence 2022 to the end of 2022. And this was a Rip Van Winkle limbo. I mean, Lord, what a joke. That they were trying to block its implementation, and again they failed. Now, this also telegraphed that the BIS would ultimately have to become NSFR compliant themselves, forcing them to square up and repatriate all these naked short bets laid on the books of the agent LBMA banks, who are privileged to have gold accounts with the Bank of England. So, and just want to say, we also drew public attention to these short covering BIS footprints when we did our very public facing 16th of November live from the vault episode, and we subsequently reported that the footprints into the November 22 lows showed that the BIS had utilized this 3rd of November COMEX-centric dip, which is like the paper dips we're seeing now, into the spec-driven 16, 18, 30 lows burned in the brain to clear the way for the BIS to square up agent banks' liabilities and to accumulate a very strong unencumbered bullion position to bolster their site accounts. It was no surprise to see this play out. Now, the issue here is that during the course of 2022 trading, as these gold derivative bets were repatriated from the agent bullion banks, who clearly had a central bank guarantee against these leased out gold positions, the very fact that the 10 times larger than directly related undeliverable COMEX positions had to be physically backed by these same agent market making bullion banks, liquidity providers, and all other liquidity providers for that matter, it opened up the Achilles heel for the EFP mechanism becoming physically deliverable. Hey guys, and that is exactly what we're seeing now. So with that, I'm going to bring on Alasdair. Welcome. It is so nice to have you, and thank you. It's an actual privilege for us here to have you join us again. Everyone asks for you, and it's nice that you've been able to find the time to join us. And I think what I want to draw attention to, because we've done a market update, short time update, we're now looking at the bigger picture, and who better to bring in than yourself? And your tale, what got my attention really was your tale of the Two Worlds article, was an absolute masterpiece, my friend. And I really do encourage people to read it if they haven't already. There's just so much to digest. But if we focus really on what is on the front burner, you drew attention to Sergei Glazyev's recent article in a Russian newspaper telegraphing basically settlement of trade between a wide range of members of the SCO. So I think it's a great place to start. Alasdair, please share your thoughts, my friend.
Yeah, it is. I mean, we live in fascinating times. I mean, gold bugs like me have been saying, gold is money. I mean, legally it is. And, we should tie currencies back to gold, and then we wouldn't have this situation of everybody's savings being devalued, and so on and so forth. It would also impose some discipline on governments. But we're not going to do it. It turns out the Russians are going to do it. And this story is fascinating. It really is. I mean, for some considerable time, we have seen Russia and China assemble between them. You refer to the Shanghai Cooperation Organization. That, if you like, is the master plan. It started as a security-based operation back in, I think, in about 2000, 2002, something like that. Because at that time, you may recall that there was a real sort of jihadist, extreme Muslim movement going through all those countries in Central Asia. And there were big concerns between Russia and China that this would get out of control. So they formed this union along with the nations, if you like, in that area. And it's expanded and expanded. And it turned from a security organization into a wider economic union. Now, it's a loose union. It's not like the EU where, you're under the thumb of Brussels and Brussels does all the regulations and all the rest of it. No, the way this works is, you're part of the Shanghai Cooperation Organization. There are other countries which are members. There are other countries which are dialogue partners, and there are other countries which are associates. So you've got sort of different categories of membership, and they each do their own thing, and nobody interferes with anyone else. I mean, we have this situation where you've got China having border clashes with India. Both of them are members of the Shanghai Cooperation Organization. They've got their own sort of political agendas and nobody interferes with anyone else's. And it used to be like that in this country. If you go back to the time of Lord Liverpool, Castlereagh, and so on and so forth, what Britain did was, particularly with Europe, it protected its own interests, but it didn't tell other people how to run their countries. It didn't moralize about the things we moralize about. We condemn the violence against Uyghurs and all the rest of it. No, I mean, this is it. So we really do have two worlds here, and I think it's important to understand that. There's a lot of propaganda in the West. There's a lot of propaganda in Asia as well. So we can't actually rely on government information. We have to, if you like, do a bit of digging and use a little bit of intelligence to get where we are. Now, really, for some considerable time, central to the whole SCO project has been the desire to do away with the dollar. Why? Because the dollar is weaponized, and this was proved a year ago, virtually to this day. And not only that, but every transaction that's done through the dollar, unless it's in the euro dollars market, in other words, offshore from America, is settled through a money center bank in New York. So the Americans have the intelligence about all the trade that's going on, whether it's buying copper or whether it's selling, widgets from, say, Taiwan to Uzbekistan, whatever it might be. They have all the information. This obviously gets up the nose of Russia and China for obvious reasons, and so they want to get away from it. Now, the strategy so far has been to just let America make all the mistakes, and we've seen this. They've tried to destabilize Hong Kong back in 2014, with the Occupy Central riots and all the rest of it. And basically what happened was that China just rode through this. You've had Syria, which has engaged the Russians indirectly. What happened was that the Americans really sort of went in there. Not fully, because Britain refused to back them. I think this was one of the better things that Cameron did. He actually put it to Parliament, and Parliament said no. So, that didn't actually deteriorate into a full-on Iraq-style war. Then you had Afghanistan. Now, they pulled out of Afghanistan. Why did they pull out of Afghanistan? It wasn't just a question of chucking money at the thing, but the Americans could see that NATO's resources would probably be needed to if you like, in the Ukrainian theatre of war. And from Russia's point of view, it saw the Americans on the run the whole time. The whole of the Ukrainian situation has been really about these two superpowers, the one trying to protect its borders and not really caring very much about anything else. I mean, we've had this thing, James Baker back in, the time of Gorbachev saying we will not move 1 inch eastwards. That was his phrase, 1 inch. We won't move 1 inch eastwards. What happened? The Americans then ratted on that and basically, sort of moved all the missiles into Poland and, the Baltic states and so on. So, Russia doesn't trust the Americans at all. So it's been going for some time. Now, this business of just letting the Americans make the mistakes has been fine until we had the Ukraine war, which kicked off, I think it was on the 28th of February last year. So we're coming up to the anniversary of the start of that. And what happened then was that this financial conflict really came out into the open. I mean, not just the military one, but the financial one. I needn't go through the history of what happened, but sanctions and also SWIFT and all the rest of it. Basically, a very, very clear message was sent to every country in the world that if you don't conform to what America wants, then they will make your bank reserves completely worthless because it's all fiat currency. So what do? You've got to have gold. That's the first lesson. And the idea that they could sort of ring fence and stop Russia selling its oil to its major markets, it just completely backfired. The other thing they underestimated completely was the resilience of the Russian economy. I mean, the Russian economy is a production-based economy. It's not a financial one like ours. I mean, we're used to sort of getting the Chinese to make this and that and all the rest of it. No, Russia makes its own stuff. It's also got some very good friends making similar stuff with a similar attitude. So it's got the resources when it comes to chucking, men, missiles, everything at a problem for longer than anyone else dare continue. I mean, these are not people you take on lightly. We now have the situation where it drove up all the commodity prices. It drove up the the gold price. I think sort of from around about mid-February last year, it went up from around about $1,800, I think, to 2,070 in early March. Now, I'm digressing just very slightly, but please bear with me. We now have, we're on the eve of a new phase in this war. I mean, they're trying to send tanks in and all the rest of it. Why is this? They're sending these tanks in? Well, because they know that this is going to kick off again. As soon as the ground's frozen, it then becomes suitable for tank warfare. The Russians are going to attack in their own timing. So what we're going to see in the coming weeks, and it's a matter of weeks, I think, rather than, months and quarters, is we're going to see this whole thing escalating again. And so, you should note that, the energy prices and also gold prices and things like that are going to be on the up due to this, if nothing else. So now, meanwhile, while all this has been happening, there are a number of events which we should be aware of. The first is that I think it was back in about April, Sergei Glaziev, who you referred to, was appointed as head of a committee of the Eurasian Economic Union to consider the construction of a new trade settlement currency. Now, the purpose of that currency was to be acceptable to everybody who partook in it, and it was intended to be wider than just the Eurasian Economic Union membership. And at that stage, he made a statement that, their initial thoughts were that it would be a basket of the participating currencies, commodities that they traded in, and gold as well. Glazier's views gradually changed. I mean, I wrote an article after he came out with that saying this is completely impractical. And I produced a number of charts that showed that, the best way you could do this was literally just have a currency which is linked to gold, simply because if you look at the gold price of all these commodities, basically the gold, these commodities and gold just move sideways. I mean, okay, at the very worst over the last sort of 50, 60 years, the oil price has sort of doubled in gold. But I mean, that's nothing compared with what we've seen priced in dollars or sterling or euros. The worst it's been is it's fallen to something like, sort of 60%, if you like, something like that. So, there is volatility, but it's not actually that great. That's the important thing. Indeed, throughout history, gold has always pretty much retained its purchasing power in a basket of commodities, goods, however you like to call it. I mean, that's the purpose of money, to retain the purchasing power, and so that any fluctuations you have are actually in the individual goods, not in the currency itself or the money. So that was the answer. And Sergei Glazier then finally wrote this article, which was published in a Moscow business paper, where effectively, I mean, I could have written it. You could have written it, Andy. Gold is the way forward. And bear in mind that this man was also suddenly proposing the new Moscow Gold Exchange because they'd been shut out of the LBMA. Now, I sort of thought about this, and I think, well, the fact that they've been shut out of the LBMA actually doesn't matter at all, because they've got no intention of selling any gold into London anyway. All they needed to do was provide an alternative to the existing mining industry, and that's basically what this new Moscow Exchange was doing. But you could see that with that, and then with Glazier's article on the 27th of December, he said, we want to get Russian gold mine output up from 300 tons a year to 500 tons a year. They're doing what the Chinese have been doing. They're chucking a whole load of money at getting this stuff out of the ground. Why? Well, as Glazier said in his article, at the end of the day, if our currencies are going to work, we've got to go on to gold to protect ourselves from the collapse in the West. Now, I just want to go back to around about June last year, when there was the St. Petersburg International Forum. This, if you like, is rather like the World Economic Forum, but in Russian, and for rather a different sort of attendee. About 81 governments were represented at that, along with 14,000 attendees, and it was a great thing. But Putin stood up in that and said, why would you want to hold in your reserves dollars and euros, which at that time were losing purchasing power at the rate of 8% per annum, and when this could be weaponized against you and be absolutely useless? And why should you have your gold reserves in London or in New York or Paris or whatever? I mean, it's just absolutely nonsense. So he primed the whole thing, if you like. Then we saw, and this is it, this is very interesting, we saw the Saudis, we could see that they were shifting towards the Russians. I mean, do you remember there was I think it was a G20 meeting back in Riyadh or something, and MBS did a sort of high five to Putin, and it was fascinating watching the body language in that, because they couldn't resist doing it, but they didn't want to show any more than that. Obviously, there were agreements going on behind the scenes, and they knew that they needed to work together. Because Saudi's problem is, we've told the Saudis and we've told everybody in the Gulf Cooperation Council, we do not want your fossil fuels. Take them away. We're not going to be your customers in 5, 10 years' time, whatever it is. So what do? Well, the answer is that the Qataris did a 27-year supply deal to China for natural gas. And then President Xi comes in, and look at what happens there. I mean, compared with Biden visiting, which, he was lucky if he saw MBS. I can't even remember if he did. I think if he did, he probably saw him for no more than half an hour. Biden was coming in saying, please pump a little more oil out. Yeah, well, sure, what else you got to tell us? And President Xi comes in, and the pictures of the motorcade with, horses riding alongside the full thing, when the jets came in, with all the colors of the Chinese flag. I mean, this was real stuff. It really was. And China agrees with Saudi Arabia that not only will they take the oil, and the Saudis will accept payment in yuan, China will also invest a similar amount back. I mean, I think the gap is something like about $2 billion equivalent in terms of trade in favor of, or balance of payments in favor of the Saudis. So, out of about $60 billion trade, I mean, there's only about $2 billion, which is net settlement, because of and this is the way China's doing it. They've got the savings to do it. They don't need to print the money to do it. They print credit, yes. I mean, all banks do that, and the banks are controlled by the Chinese. But you can see that the strategy is actually quite simple. We will trade with you, and where, we buy your oil, then we will invest back in your country and help you build your infrastructure and all the rest of it. And we will build the communications. What we have out of all this is really a combination of things, because the Saudis would not do this yuan deal to spite the Americans. I mean, they may wish to do that, but that's not practical. They would do it because they're being offered a better alternative. And that better alternative, I mean, we've been looking at it and saying, well, of course, the thing about the Shanghai Gold Exchange and the Futures Exchange is you can segue out of a yuan contract or an oil contract into gold, and yeah, sure, I suppose you can. But actually, I think what's happening is that these trade imbalances, and this is after the money that's come in where you've got a deficit with someone, you're investing into Saudi Arabia or wherever it might be, the balance is only $2 billion equivalent. And that is going to be settled predominantly in gold or something that is tied to gold. That is the message we're getting now. And I think this is desperately important. In terms of how important, bear in mind this: we are a decaying, advanced world, and we are about 1.2 billion people. The Shanghai Cooperation Organization is 3.8 billion people. Their suppliers, including the whole of Africa, a further billion. You've got Latin America. Now, this is another interesting little development. If you look at, we've been hearing that Brazil and the Argentines and maybe a few others are talking about getting together and doing a common currency. This is all a big joke, isn't it? Because these guys couldn't organize a currency for if they tried. I mean, look at the result, But it misses the point. What they're doing is they're coming up with a trade settlement currency which is acceptable to members of the SCO. And that will be gold backed. It will be solid. It won't be like the Argentinian peso. This is very, very important. And here we are, 1.2 billion out of a global population of nearly 8 billion. Are we are we the power players in this? Those 3.8 billion people in Asia are going to be rapidly industrializing. They're going to go through an industrial revolution with sound money in exactly the same way as Britain did from the introduction of the gold standard in 1817 through to the First World War. That is what the world now faces. So what it means is that gold is going to go back into being, if you like, the keystone to the global monetary system. And if we don't go with it, our currencies are dead, completely dead. I mean, think about the effect on the dollar. I mean, For a start, this always happens. This always starts in the foreign exchanges. Now, the foreign exchanges aren't necessarily going to say sell dollars to buy euros or sell dollars to buy yen or whatever it might be. What we're talking about is we're looking at roughly 30 trillion of foreign-owned financial assets and deposits in the banking system, which will be losing money the longer they stay in dollars. What are they going to do? They're going to get out. Imagine the impact of that $30 trillion trying to get out of the US dollar. A lot of it will be collapsing share prices, for example, because I think the portfolio element of this is about $13 trillion. So this is significant. It also creates enormous problems for the US government because they've been relying on foreigners to fund the debt. Foreigners turned sellers at the time when, heading into recession. The idea that the budget deficit is under control, forget it, it's going to get worse, and the foreigners are going to be selling treasuries at the same time. This is the worst currency nightmare you could possibly imagine facing the Americans. And in terms of timing on this, I think it's tied, I think, to what's happening in the Ukraine, because I just put myself in Putin's shoes, and I can see that the easiest way to shut the Americans down is to progress these plans very rapidly. So he will send in his tanks, whatever it is, he will try and reclaim the Donbass and so on, and he will succeed. He will succeed. Of that I have no doubt at all, because he has regrouped, he's changed his leadership, learned lessons, he knows what he's doing. He's also got superior missile technology, which hasn't yet really been deployed. This is going to be nasty. It really is going to be nasty. But the way to stop the West from really backing up the Ukrainians with, missiles and all the rest of it is actually to bankrupt those nations. And that, I think, is what he's going to do. So I think that this new phase in the Ukraine situation gives us the timing for gold.
Yeah, this is fascinating. Look, this is the kind of detail we can't get anywhere else. Now, look, Alasdair, the scale, what's telling me here, the potential scale of this upcoming de-dollarization, the velocity is not priced into the dollar or commodities. Now, every bank I speak to is already, this aside, is already expecting 2023 to be a commodity super cycle with record high commodity prices. Good God, add gold into this picture. Silver, for example. Silver is a commodity. And we're talking about all-time high prices in all commodities. Where does that place silver? To me, add in gold and what you've just talked about, all of these pieces fit together. And on the first trading day of 2023, Sparebank announces they are digitizing, put it on the blockchain, digital gold. But it's physical gold that's been digitized, and it's a trustless blockchain. You know that every single gram there. This is the weaponized missile. It is, and it's how do you employ this? And you could literally gram for gram price every single commodity on the planet Earth. The velocity, to me, Alasdair, is inconceivable.
Yeah, your point about Sberbank, I think, is absolutely to the point, because they will know what Glaziev is intending. So this is, if you like, a forerunner. It's they're sort of trading ahead of the developments. I think it's a very clear signal that everything is going in that direction, and the concept. All fiat currencies come to an end, and the last people to recognize it are generally the people who use the fiat currency for their day-to-day transactions. And when we talk to our American friends, they don't see this at all. They really don't. A few might, but the vast majority, and we're talking about some pretty sophisticated financial brains too, they don't see it. They really don't see it. It always starts in the foreign exchanges. And then, it's the Ludwig von Mises classic situation leading to the currency collapse with what he called the crack-up boom That last moment when suddenly, people on the street realize that what's going on is not prices rising, but their currency collapsing. So what do? Just get the hell out of it as quickly as you can for anything, even if you don't need to buy it. Just dump the currency. You're not buying things, you're just getting rid of the currency. You're getting rid of any liquidity which you can, because you know what's going to happen to it. It's the currency that is collapsing, not prices that are rising. The moment the general public understands that, then there is no way back for the currency. It's as simple as that. And that's the first stage in this always is foreign selling, always foreign selling.
Yes, I was also thinking more on this side of the pond now. I was also fascinated by your take on the do or die Ukraine conflict. Really, that really got me thinking. I hadn't thought about this. Germany's role really, and their interests, as you pointed out, lie more in line with the Asian hegemons. And we're looking at the potential collapse of the EU here. Please, come on, give us some information here, because certainly you're onto something which I hadn't really thought about.
Well, the EU is a dodgy thing anyway. So, I think we should be glad to be out of it. I know there are lots of Remainers running around thinking, we've got to get us back in somehow. But actually, it's very dodgy. It really is. I mean, the whole thing is just complete nonsense. I think the thing we need to understand about NATO is that, in the words of Lord Ismay, who was the first Secretary General of NATO, he said the objective of NATO is to keep the Americans in, the Russians out, and the Germans down. And so we've been suppressing the Germans really since 1948, which I think was the year NATO was founded. And it is desperately important to America that Germany remains on this side, if you like, of where they think the democratic curtain, if I can put it that, is. But if you look at it from Germany's point of view, in fact, Germany as an economy has enormous potential to gain from what the Shanghai Cooperation Organization is doing. I mean, they are the producer of high technology, electrical and mechanical goods, the sort of machines which are going to be needed, things, and also, all the civil engineering stuff and all the rest of it. I mean, the Mittelstand is so strong as an entity. You have a production-based economy, which actually is, if you like, it's a square peg in the round hole of the EU, which is increasingly financialized, as we are and as the Americans are. They actually are far more naturally part of that Shanghai Cooperation bit. And interestingly, I suspect that Scholz, I think he realizes this, and I think he realizes the dilemma that he's got, and that is he doesn't actually want to shut the gate on Russia. And I think that was part of the reason why he was very reluctant to send Leopard 2 tanks and to authorize, others who had bought these under contract to do the same. This was sort of put out, and I think there is something in it. It was put out as the idea that you don't want to see the Nazis back there with their tanks and all the rest of it, 70 years after after the last effort. But I think a lot of it is that Germany realizes that this whole situation is extremely fragile, and she needs to keep her options open. Furthermore, the intelligence that we get is that the Americans might have considered doing a deal with Moscow if it was just a question of negotiating over the Ukraine. But the one thing which they would not be able to agree on is NATO. And NATO is there to keep Germany down. This is the whole point. So what the Americans were not prepared to see was, if you like, the Chinese and Russian hegemons running from Vladivostok all the way to Koranya. I mean, this is, this as far as they were concerned was an absolute no-no. So that's what they're fighting to defend, and that's what they're roping us into doing. And I mean, why we're falling for it? I mean, this is not good. It really is not good. And I think, I mean, France is also France is in a sort of wishy-washy position, really. Yeah, Macron wanted to try and say, well, I can lead the negotiations and all the rest of it. He was doing all this sort of French flummery, if you like, over the whole thing. But the key to it is Germany. I mean, the SCO would be a lot more powerful with Germany on its side of the fence, and the Americans are determined to prevent that. And I think this is why they came out of Afghanistan, to defend that situation, to defend the Western European interest.
This is hugely interesting, hugely interesting. And I think it was, I think last Thursday, I think in a really angry rant, the Ukraine defense minister, I can't pronounce it, Alexei Reznikov or whatever it is, he came out in this rant and completely verified, completely underscored that we are carrying out a NATO mission today without shedding their blood. I mean, good God. I mean, so you've got that admission, but then what really funny how these pieces all come together. And it's like, I never realized that Israel, when they tried to negotiate a peace settlement within a month of the conflict, it's not a war yet, because if it was a war, we'd know it, that this conflict started. And this is where it really pees me off, because Germany, as you say, and France were very pragmatic about, yes, and all Russia was asking for was, look, an agreement not for Ukraine, not to, they can keep arms, but an agreement never to join NATO. I mean, goodness me. I mean, this was a doable deal. And what happened, and this is what pees me off, is that Boris Johnson turned up physically and scuppered that entire deal. And I think Boris has blood on his hands. And I'm really, I mean, I had support for him for many years, and that completely blew that. But this was solvable in the early days. So clearly who's driving this? It's clear which country is driving this, Alasdair.
It's not just Boris. I think the American neocons are very much behind this.
Yeah,
that's how I see it. And all the evidence, I think, points that way. I mean, the journalist Pepe Escobar, whose intelligence contacts are second to none, really, so far as I'm aware. He sees it that it is the neocons who are really driving this, the Newlands of this world. And I mean, God help us. That they're almost sort of rather like the sort of Dr. Strangelove types over there, who seem to be calling the shots. I mean, we want war. That's what they're doing. And to my mind, I think I have an optimistic view on this, and that is that the whole of our system is completely rotten. As a society, the West is falling apart. I mean, all this woke stuff and all the rest of it, and with politicians tying themselves up in knots. This is the end of a road, in a sense. And the debasement of currencies is an accelerating issue. We're destroying ourselves. We're not going anywhere. We're not achieving anything. So, this has really got to come to an end. And if it comes to an end with a large part of the world returning to the values which we really value, like sound money, gold, and so on and so forth, as being the backbone for credit, then this is good. This is good, because it will force us to stop doing what we're doing. We will have no option. And I think the great thing is that you can't just nuke someone because you don't like their financial attitudes. You nuke them as an act of physical war, not financial war. Though I think reintroducing gold is the equivalent of a nuclear war against the fiat currencies. and good riddance to them. As far as that's my view. So I actually take some. My takeaway from this is actually really very, very positive, but it's going to be rough, very rough. Think about how. How long is it going to be before the whole of the Westminster and Whitehall establishment, the whole of the Washington establishment, kicks out this Keynesian rubbish and actually goes back to classical economics? That's really what we're talking about in theoretical terms. And this is going to be, you're going to have people who just take a grip of the situation to stop it deteriorating so that the currencies are completely valueless. The answer is you use the currencies as a means of distributing a better currency, a currency which is actually backed by something tangible, and that is gold. That will be the last function of dollars, euros, pounds. And it's just so sad that we've got, what have we got, 300 tons or something? We've sold most of ours at something like $275. Oh dear, it's enough to make you weep, isn't it?
And America is very likely that the 8,300 tons they've got is really likely compromised, rehypothecated. We know that because of the German situation, where why would you not allow them to come and inspect the vaults? Why would you not allow them to have their 300 tons? We could put stuff, you can put, and Alasdair, you could put 20, 25 tons on a plane, and you could have done it in a week. But no, it was originally going to be 7 years. But I think what you're talking about here is the smart money is already onto this. And Alasdair, that brings us on to probably the last thing to talk about today is the BIS going net long gold. And, if you remember, and of course you remember because you were all over this with us, the BIS commenced 2022 trading with over 500 tons of swaps leases on their books. And again, you were there with us on this. When they were telegraphing that they were going to square these derivative bets when they imposed these NSFR conditions on the liquidity devise, providing the over-the-counter spot market liquidity. And bang on, year end, zero. Any surprises there? Because and this is the other thing, who are these guys trying to call tops here? Give your head a shake. If the central bank of central banks is net long gold, if we're seeing more gold being bought by central banks than since Nixon closed the gold window 50 years ago, what the hell are people talking about trying to call the top on gold?
Yeah, well, you're right. From a central banker's point of view, the answer is quite simple. Gold goes along like that, and your currency goes down. So what do? You print currency to buy gold. It's it's the simplest thing to work out in the world. But the point about swaps and leases and so on is interesting because if we go back to 2002, Frank Veneroso stood up at a conference in Lima and said that he had worked out that something between 10,000 and 14,000 tons of gold were out on lease. And I think he described it as being round the necks of women in India and China. Well, it wasn't China then, but certainly India. At that time, 14,000 tons was half the total declared central bank reserves of gold, which was around about 28,000 tons. Now we're up to 35, 36 or something. Now I just wonder how much is actually out on lease still or swapped still. In other words, from the point of view of, if let's say that the declared total is 36,000 tons, some of that is double counted. There are two owners to it. And if there is a significant amount of it, then I think there are going to be some central banks which are going to be very embarrassed. And I suspect that those are going to be central banks in the West. I can see a lot of the minor ones. With the help of a journalist from the Times, I think it was the Times, I uncovered a situation in Finland, which was quite fascinating because they had something like 60 odd tons stored at the Bank of England. And, the woman who was responsible with the central bank for this particular department, in her blog in Finnish, boasted that they'd been half of it was out on lease and they were earning good money on it. And anyway, I got a Finnish friend to translate this, and when I went public on it, it was immediately withdrawn. So, it's absolutely fascinating. There are going to be a lot of Western central banks, I think, who say that they've got so much gold, but actually, when it comes to it, they don't actually own it. They're owed it. So this is going to be, it's going to be a voyage of discovery, a very interesting voyage of discovery, I think, this SCO, move into gold. And the BIS, as you say, clearly signalling that they don't want to be short of this stuff at all. They want to have an even to a long book, and that's where they are.
I think, as you say, one only has to look at the size of this issue that was not on the table. Even some of the mainstream still haven't caught on to this, but it really hasn't been in most people's awareness. But what gets me is the size of this, the velocity of this. And people talk about, the dollar, give it be 10, 15 years before the dollar loses any kind of... Hang on a minute. Look, the dollar, the velocity of this is mega. And it really will accelerate, especially now we've seen Russia digitizing gold into grams, so you can price commodities in grams. And we have other information that says that, furthermore, other people have also adopted this process. And why wouldn't you? Because it's simply a question of buying the gold physically, or taking physical gold you own, putting it on the blockchain, and then using it as a currency. So it becomes the currency, and it's the only currency, as you rightly say, it can be the only currency that can really be the benchmark for a physical product, for a commodity.
Yeah.
And there we are. Here we are, in 2023, Sberbank kicking the ball off. As you say, they're in the know. It's happening. And I think people need to give their head a shake and say, well, I think as Robert Kiyosaki said, Alasdair, how much physical do you own? That's the only thing he said. He kept saying, but how much physical do you own? And I'm sure that is your mantra too.
Oh, completely. There's no point in having paper. And the other thing which I always insist, and this was really first indicated to me by my colleague James Turk. He said you don't invest in gold. You hoard it. It's money which you will spend. It's not something to look at it from the point of view that I bought it at 1600 and it's now 1873. No, that's not the way to look at it at all. If you want to play that game, go and buy a mining stock, or play the paper market or something like that.
Absolutely.
But but this is actually about protecting yourself against some very, very wild and big forces, far bigger than any of us. And if you don't protect yourself, what we're looking at is the complete collapse, potentially the complete collapse of the fiat currency system and everything that depends on it. How are you going to price, even mining shares in fiat currency that's collapsing? If you remove the fiat currency, you've got no price, basically. You might say it's infinite or something, or close to it in Venezuela and whatever, or, the dollar goes that way. But, the point is that, in these collapses, there is a hierarchy of assets which you need to own. The first is real money. That's the main thing. And that's gold, silver, copper coin. I'm going way back.
Yes, something tangible.
Something tangible. With no counterparty risk. As the great J.P. Morgan, the original John Pierpont Morgan, said in testimony to Congress in 1912, he said, gold is money and the rest is credit. And he's dead right. And that's it. You don't want the credit. In this sort of collapse, you don't want to have to rely on someone else's promise to pay you, which is actually what credit is. That's counterparty risk. You don't want it. You want to have the physical stuff. Then, if you go back to what we saw in the German inflation in 1923, there were stories about American students in Berlin. Out of the daddy's allowance, they were able to buy literally streets of houses. And that was what happened to property prices in that sort of scenario. Whereas here we are, we think of property as being an inflation hedge. Well, sure. But I mean, and also the great Austrian writer, Stefan Zweig, recounted at that time that you could buy a six-bedroom house in a swanky part of Berlin for $100. $100 at that time was convertible into 20.67, or at the rate of 20.67 to the ounce of gold. So it was just a bit less than 5 ounces of gold. Bought you a house to die for. But I mean, and rental property basically went valueless. Why? Because the cost of maintaining it was higher than the value of the property. So you get this idea that there is an escape from this sort of currency collapse, which is not owning physical gold or physical silver, is completely wrong. It's bananas. There's only one way out of it, and that is to protect yourself by just getting completely out of the fiat system and everything that depends on it. And that, I think, is the big, big message that we're getting from Russia. Very senior people are on this, and they're all saying the same thing, and it's becoming more and more clear. And your point about Sberbank doing this digitization of gold, they're front running it. I mean, it's as simple as that. So we've been told.
Yeah, do you know what? Physical. And please pass my regards on to James Turk. He's a true gentleman, and have a lot of respect for James and all he's achieved. So
he's great. He really is a great guy with enormous knowledge. I know.
I had a lovely lunch with him one day, and I just, that lunch could have lasted the rest of the day. But Alasdair, thank you so much for joining us, and we've only covered some of what I was hoping to talk to you about, and delve into the wonderful mind you have there. But perhaps you'll join us again soon, won't you?
Yeah, I'd love to. All right. And particularly when you're so nice to me. I mean, I'll always come back.
Okay. Well, thank you, Alasdair. Thank you very much for taking the time to join us today.
It was very much my pleasure.
Well, thank you so much, Andrew Maguire and Alasdair Macleod, for another. I knew it would be a fascinating discussion. And remember, buy physical and make sure it's 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. Now, I'd like to ask you to please help spreading the word about this channel by hitting that like button, sharing it, and subscribe to the channel. And if you want to be notified as each episode goes live, just click on that little bell there, and we'll send you those episodes as they go live. And with that, we'll see you next time right here on Live from the Vault. We'll see you then.